Hey guys, welcome to the Red to Black podcast hosted by Warner, and over here is Mario. And today we're discussing two different things: NFTs, my thoughts on them, Mario's thoughts on them, and then also this company called Atbash. It's a play on real estate, and cryptocurrency is actually really a play on you if you're foolish enough to get into it. Before I begin, what are we here to do? We're to support you in avoiding financial destruction. So Mario, let's get started.
Yeah, this is going to serve as a public service announcement for my nephews out there, and this is going to age really well. So this is being filmed, or we're going live today on January 20th, 2022. And this initial coin offering is going to go live on February 7th or 8th of 2022. So just a few days from now, this Atbash coin is going to go and they're going to issue about 85,000 coins. So why is that important? Well, it's just another cryptocurrency, except this one has some pretty smart guys behind it who have created a incentive for you to buy the coin or to get involved with the protocol. And what they're going to do is they're going to offer to back a real estate transaction. So if you bring them any type of real estate, you can farmland, residential, multifamily, commercial, industrial, dentist office, any strip mall, anything you can find that you can get under contract, you bring that contract and 50% down payment to them, and they're going to hold it for 30 days in escrow. And at the end of 30 days, they're going to purchase the entire property free and clear for you. So they'll hold the money, the 50% deposit. And at the end of 30 days, they're going to buy the property and you're going to own it free and clear. Maybe it'll take 90 days to finally clear, all the title companies or whatnot. But you'll own that company at the end of 90 days, free and clear for a 50% deposit. So how are they doing that? They're going to leverage, or they're going to provide leverage on the margin to accounts that are trading the Atbash coin or trading cryptocurrencies. So they'll sign you up. You bought some cryptocurrencies and you want to trade it. They will provide that leverage with that escrow account. So they're going to use that as collateral, or use that money, that deposit to loan, just like a bank would. And they're going to make so much money loaning your money, or that deposit, that 50% down payment, that they can pay for your property in 30 days free and clear. This will end badly. I think it'll be huge. I actually like the gentleman behind this. I think they're interesting guys. For instance, I'm gonna probably try to say this in a way that doesn't get this banned. Just for like signing up for their wallet, or just for like getting involved with this, they're gonna send out some Glock 80% lowers inside the United States to folks that are, so they're attracting a real Wild West character of people that are going to be involved in these kind of real estate transactions and cryptocurrency and trading it. But this thing will blow up. They have to get such a high margin on that money per week that to pay that 50% down. It's just a big bubble. It's going to create a big bubble. I think it will attract capital. I think somebody will take the risk, and it's like somebody got $1 million property for 500,000, or a $10 million property for 5 million, and that'll spread like wildfire. What are your thoughts, Warner?
So first thing for our listeners, I want you to think about anytime you have a new, let's say, opportunity. Let's just call it an opportunity. Let's look at everything as an opportunity until proven otherwise. And I say that in quotations, proven otherwise. So first thing you want to do is you want to go look at, or first you want to take a piece of paper, right? And on that piece of paper, you want to write down basically all of the like steps to the whole process you just described, right? So if I can recreate what you're saying, you go find an asset, number one. Number two, you look in your bank account. Okay, this is how much money I have. Okay, I can do that asset. Number three, you go engage with these guys and you say, okay, I'm at this asset, I'm at this price. You send them your money, right? Now, the next thing you want to look at is on that sheet as you're writing this down, where's that money going? What's the escrow account? What's the insurance? If I wire that in, what's my guarantee that's actually going there? And then after that, I'm quite fuzzy to the rest of it. Do you get the cryptocurrency? Do you get?
No. So you take that signed contract. So you got a property under how I read this. Again, this is a white paper. It's a protocol. It's a fork off of another cryptocurrency. So they're just copying cryptocurrency, and forking with little additions. And this, as the forks are happening, these additions are getting more outlandish and more crazy and more bubbly as you can. This is this is where we're at today, is that you take that 50% deposit and assign real estate contract. Let's just say you're buying a multifamily piece of property and you have the 50% down payment. You're putting that into escrow with them for 30 days with the expectation that at the end of 30 days, they will go to closing on your behalf with your 50%, and they'll add their 50%. Free and clear, you'll own that property at the end of 30 days. What they do to generate that 50% to match your 50% is loan that money for 30 days at extremely high interest rates per week or per day to generate the 50% to add to your 50% to buy that property free and clear. And then you would think, well, what happens to reading into this white paper, learning more about this Atbash protocol? What do they do with the excess profits, let's say, at the end of the month? So let's say they matched your 50% and they have excess profits at the end of 30 days. They're going to buy treasuries, or they're going to buy bonds, government bonds, and that's what's going to back the cryptocurrency. So the net present value of that total bond portfolio at the end of 30 days, 90 days, a year, 10 years is going to be backing the cryptocurrency. These gentlemen are going to make money off of owning some of the initial coin offering. They're going to own some of those initial coins and they're going to have some value. They might become billionaires if they can make this thing compound long enough. But to answer your question, yeah, so that money is going into a escrow account. Now, obviously, the terms of that escrow account are that they are going to collect interest. They're going to loan that money and collect interest on that money in order to make the deal work. Will it work in the short term? Probably. But eventually, everyone's going to have to keep gambling with cryptocurrency in order for them to make interest. They have to make interest because they're telling you at the end of 30 days, we're going to match your 50% and we're going to bring to closing on that real estate transaction 100% of the closing cost. You own it free and clear, but you only put up 50%. So it's interesting. I think it'll attract attention, but you're right, Warner. You need to go through the steps and think about, before you put that 50% down, and think about how are they making this money and what guarantees do I have? And I would assume that you have almost zero guarantees other than, well, it should work out.
So here's what I want our listeners to think about. When you go after some asset like this, I want you to ask yourself, how complex is it? Because if you look at a real estate, buying just a piece of real estate, you say, okay, there's the value of the real estate. I know I got to put 20% down, say it's $1 million, 200,000. I raise 800, or I get 800,000 loaned to me. Maybe of that 200,000, I put down 50,000. I raise 150, right? If you can, now you go above that with construction loan, or you raise your own construction loan from your investors, right? And then you put it all together, get all the monies together, you execute an agreement, and you buy the property. It's pretty simple. It's actually super simple. The challenge with this, I have multiple where you guys have to really be careful. You said a few things that just like the red flags went up in my mind. Number one, what is the underlying technology they're forking off of? How secure is it? What are the original rules of that technology? Who's running it? Who's running the servers? How does it transact? See, that's so damn confusing right there. Trying to just figure that out. And then number two, when they take your money, how do you know, like, okay, so obviously they're going to take that money and they have to put in a bank account, because they're going to have to put in a
So
bank.
they're running their own bank. They're running their own type
Yeah, but they
of
can't.
financial institution.
Yeah, but it's going to have
They're
to.
going to lend that money.
No,
They're
no,
going to lend that money at the margin, on the margin to their
Yeah, but
crypto.
they're not going to. They are running their own financial institution, but at the same time, they have to go through an intermediary. So say the money is in, let's say, Chase, Mint or whatever. I can't remember. These banks merge so much. J.P. Morgan Chase, right? The money sits in that account. That's my account. You're the guy I'm doing business with who owns a crypto exchange. It goes to your account in your bank, and then you're going to take that and execute off the exchange, unless I'm directly wiring to an exchange, which I'm not sure how this works. The challenge here is there's a risk from taking that money from point A to an escrow account that I have no idea who owns that? What if the money gets sideswiped or taken before it even gets to that escrow account? Now that's in that escrow account, okay, you're loaning out the money. Well, the question I ask is, we know in the crypto markets, there's like, from speaking to people, 5 to 10, maybe even 20 to 100 leverage. Okay, so
Right.
you're lending to who to do what? Because that's my risk down the line to get, because I want to say, I'm giving you my money as a custodian, and you're saying you're going to double it. Now, anytime someone says they're going to double
In a
it
month,
in
and
a month,
double it
that's
in 30 days.
walk
In
away.
30 days.
Look at the best investment. Like, okay, let's look at a high
Right. Well,
cash.
they're going to have to lend it at extremely high interest rates to cryptocurrency traders. They're going to pay 30% a week,
Yeah, but
50% a week,
to
100% a week.
to do that trade, to do that, you're doing 100% or 100% return in a month. Let's look at the normal way things work. Right now, you can get 2%. If you
A
go into
year,
like
a year,
a
a
year,
year.
so
Yeah, you can safely get 2% a
you're
year.
saying you're going to somehow avoid 50 years to double it, and you're going to do it in a month. That's where the red flag. Just let you know, man. We're live stream guys. Camera just went out, but I think it's being recorded. So just to let you know, let me see. Oh, I can see the other one. Just to let you know, that's going to take 50 years to get it back, and now you're like, I'm going to do it in a month. That red flag is enough for me to be like, no deal whatsoever.
Yeah, I think this attracts capital, and I think eventually the crypto space blows up and people aren't able to generate just insane returns, in which case they're going to get a margin call, meaning they borrowed that money and they get completely wiped out, which wipes out other people, and the whole thing collapses. It's a house of cards. But I think it'll attract, this is how crazy it's getting. I think it will attract capital because people want a free lunch. I can put up 50% and I get the entire building. I can go out and sell it. If I own it clear and free, I can go out and sell it the next month. So think about how that would work if a gentleman or a woman bought $1 million property for 500,000, sold it the next month for $1 million, took the 500,000, then went and got a $2 million building for $1 million, then a $4 million for two, and just kept laddering it. Over the course of a year, you'd own $1 billion, own a very expensive building. But if you kept going long enough, if this worked out long enough, you could just keep doubling your real estate holdings roughly every 30 days.
So yeah, that's actually extremely dangerous, because what's happening is you're going to give them your money. What happens if the margin call happens?
So
Image just came back in.
the way a margin call should happen is before a security, which again, these cryptocurrencies are trading like securities, not currencies. They're trading like a security. But what should happen is, if you've got into a margin account, you've given that lender access to meet what you've borrowed plus interest. So you have to always have in your margin account enough liquidity, enough assets that can support what you've borrowed and the interest on that. So what they're going to do is, as soon as the coin, or as soon as something happens where the price drops, they're going to have to start liquidating people that have borrowed against their assets in order to get that. That's the definition of a forced seller, someone who is being liquidated outside of they get that capital back because they can't take the risk of losing that. They can't wait 3 days or 10 days or 30 days. They need that capital. And oh, by the way, they've just, not only they're going to take that 50% that you lent them or that you put in escrow, they're going to take another. They're going to go to closing, maybe on your behalf. I'm not sure. It's just a white letter. Well, it's in an escrow account that's being gambled with. And then you're right. Are they showing up to? Are they going to show up to closing? Or are they wiring you the money at closing? It speaks to where we're at in this economy and in this bubble of cryptocurrencies, that this is what's attracting capital, is these bigger and bigger schemes of, I'll
Who's
buy
going to
real estate
close
for
it,
you
them or
on your
you?
behalf, and you only have to come up with 50% down payment, and you'll own it for.
See, this is see. what you're basically saying is you're gonna lose control of your real estate deal by giving it to these guys. You have so for a certain amount of time you have no control over your money, and you're giving it. Yeah, exactly.
Has to come down to yield at least 15%. Why would I buy a farm and go through all the labor of trying to grow corn when I can just go get 15% or 20%? Well, how does that do that? The price has to come down on that.
Well, here's what people don't realize, and I thought about this today. A guy was talking about David Hunter, I think it was on what was the channel? I watched this channel a lot. I forget the channel it was on, but David Hunter was talking to, I forget who it was, but anyways, he was talking. He's an economist. He's been or a trader, investor for like 50 years, and he's been doing this for so long that he's seen most ups and downs. And he basically said within 10 years we're going to go to this really inflationary environment where he thinks treasuries, the 10-year and the long ball one, is going to be 15%. Now I started thinking about this. If treasuries say go to 15%, which I think they will, easy with inflation of 15%, well, now guess what's going to happen? Everyone that holds a dividend stock is going to sell out of the dividend stock, push more stock onto the market. Because I thought to myself, how the hell is a company going to be able to afford to pay a 15% dividend? I mean, right now, 2% Texas or 2% at Oracle is 20% of free cash flow. They don't have enough cash flow to pay 20% on their current price. So what's going to happen? I was like, oh, as money floods out to the bond, all the stocks are going to flood the market, driving the price down, and you'll get stocks trading at a 15% because the money's going this way. And that's what
Yeah,
people.
it's gonna end bad at some point. This ends bad. That's why I said when I started off, this will age well. Just it's just not it's just a matter of time. This is gonna age well.